Traders, I'm about to show you the most profitable trading strategy that's ever existed in Forex. Let's roll the intro. Alright traders, welcome back guys to another high impact, the best place to learn fundamental analysis and to use that data to give you guys an edge in today's market. It's your boy Kleveland. We just came off of talking about the balance sheet last week, so if you didn't see last week's high impact video, it's down in the description below, okay? Yellen is going to do the tapering in October. Alright, we were expecting to start to do the tapering in 2017, but we didn't know it was going to be next month, so that gave us a lot of US strength, and we caught that US sell side move on the Euro USD. You guys can check out the last week's money market breakdown to see our forecast and to see what happened. Alright, so guys, this is my masterpiece when it comes to a high impact video. Alright, yeah, I know this is only our third one, but I think this is going to be the best of the best, okay? Economic data and the fundamental data that you guys are seeing being spit out on Bloomberg, being spit out on CNBC, over at Forex Factory, over at Seeking Alpha, all over Trading Economics. It's hard to interpret all of it. Alright, it's really hard to conceptualize how it all fits. So I've been thinking and I've been pondering over a metaphor that could help me conceptualize economic data to like maybe just one simple metaphor, one simple variable, and I can just have all these other independent variables that maybe affect how well the economy is performing or not. And I got it for you, okay? And discovering this and conceptualizing it in this way showed me exactly how we make money in trading. I already knew how we made money in trading via economic divergence, but I'm going to show you exactly how that economic divergence, the best trading strategy that there is in Forex. It's a little bit more long-term, all right? It requires a lot more interpretation of these markets and a lot more of an understanding of these markets, but when you know it and when you can align it with the technical information, all right, guys, it gives you an amazing edge. All right, this is how the top guys in the industry are assessing markets, and if you are not assessing markets in this capacity, again, you are not putting yourself in a situation that is going to reap you the profits that you want, okay? So to sum it all up, let's pull over into the blackboard. I'm going to show you guys exactly how these major players are making money in this market. So you got to make sure you're liked and subscribed so you can get involved in these moves and interpret this data as soon as possible, all right? So you have that edge. And again, as always, folks, like the video for your boy. Okay, let's pull over to the blackboard. So I'm not sure how many economists rationalize the economy as a vehicle, but that's exactly what I'm going to do. Okay, only difference is I'm going to help you guys understand it in relation to other vehicles, okay, in other economies, because that's where our edge is. Okay, the edge is how is this vehicle functioning relative to how this vehicle is functioning, and we need to know the variables inside each vehicle to understand its functioning relative to another. All right, I know that's a lot, but check me out. So I'm gonna drop a car over here. It's not gonna be pretty, guys, so bear with me. See, it's already started. Sorry about that. All right, so imagine this to be your economy, okay? And all the variables that exist within the economy, I'm gonna try to help you rationalize that in the context of a vehicle, okay? And that's just going to help you really understand how Forex works and why you can make money in Forex and why this is the most probable way to make money in FX. So the variables that we're going to be looking for are going to include the driver of the vehicle, all right? We need to talk about the gas. We need to talk about the brakes. And we also need to talk about the speed of the car. Okay? So the driver for us, folks, is the central bank. Okay? Now, why is the central bank? Let me elaborate. The gas is productivity. Now, this is where we're going to be spending most of our time today. All right? Now, the brakes are the interest rates. We'll just rationalize that as IR. Okay? And the speed of the car is going to be inflation. Remember in the last high impact video, we talked about how inflation, we'll talk about that as INF. All right? So these are the key variables to our economy, and unlike a vehicle, an economy, guys, it wants to exist forever, okay? There really isn't a destination, all right? So you're always going to have productivity happening, which means you're always going to have the vehicle going, all right? But just like I mentioned, again, you won't have a vehicle moving at all if there is no productivity. So that's why gas represents productivity for us. Okay, and based off of the amount of productivity, the interesting thing that happens, you know, unlike a vehicle, when there's more productivity happening in the economy, you usually get an increase in speed because the economy needs to burn off that extra productivity, all right? And what happens when you get an increase in speed in terms of economic growth? You can get ballooning to start to happen, all right? We saw that in 2008, all right? What we look back on every single time we make one of these videos, all right? It's a great place to get a lot of examples and to learn from, okay? And so when we see an increase in speed in terms of the economy and economic growth, what you'll see happening is an increase in inflation. All right. And you don't want to see that much of an increase in inflation. You want to see that much capital moving around in the money supply because, again, you may not really have any true value there. There may not be any true productivity happening in those areas. So what will happen? The driver, the central bank, will put on the brakes. All right. They'll start applying interest rates. And those interest rates act as governors. All right. What will happen is, as this economy and as this vehicle is moving along, as it increases in speed, the central banker inside notices that whole process happening and he says, holy crap, okay? He starts applying the brakes. And a lot of times, as you guys can know, in 2008, here's a chart, 2008, what started happening? Economic growth was monstrously just pushing to the upside. Can you guys see how those interest rates were increasing, but still we had a collapse happen, okay? They should have implemented measures before the pedal was really pushed. Okay, before the speed really started increasing, they should have implemented measures here in the productivity sector, in the economic sector via reform. Okay, a lot of time people say a free market is the perfect capitalistic scenario to be in. Government shouldn't be involved in any capacity. But you guys got to rationalize. We have these guys at the top that are making all this money. They're going to start doing things. Okay, you guys got to go back to the last high impact video to really understand this. They're just going to start implementing different ways of making money in the economy that may not be too beneficial for the economy, aka mortgage-backed securities, all right? But if the government intervened in that process to stop the banks from, being together and allowing them to get too big to fail, then maybe we could have avoided the 2008 collapse, all right? So government intervention, central bank intervention can slow the economy down. If they slow the economy down, they're usually going to do that by slowing productivity. They're going to slow productivity by raising rates, okay, by making money less accessible, all right? But what we're going to do right now is we're going to go over into gas, all right? I want to show you guys the breakdown of productivity because it's pretty simple, up to right now, but there are a lot of different variables within productivity that can help us pinpoint exactly economic growth, the type of that growth in terms of productivity. Okay, there could be a lot of productivity happening, guys, but it's not all beneficial. All right, so let's go into all the variables of productivity, and that'll help you rationalize again the type of gas going in the vehicle and if that's good or bad. All right, so some of the aspects that I mentioned earlier of the economy when I was relating it back to the vehicle have variables within them as well, right? So inflation, for example, we mentioned inflation being speed. There are different types of inflation, okay? So I talked about that 2 high impact videos ago. Again, watch that after this video if you haven't seen it, all right? And when it comes to productivity, the gas in the economy, there are 3 other variables that I look for when it comes to productivity and how it relates to how the overall economy is performing. So the first variable of productivity that I want you guys to understand is employment, okay? A lot of folks look at that non-farm payroll that comes out at the beginning of every month because it's extremely important. How many jobs have been added into the economy? That's going to help us understand the amount of productivity that's going to be happening in the economy. Okay, and remember, depending on the amount of productivity we have, depends on how much gas, all right, is being pushed into the economy, and that's going to depend on the amount of speed that the economy is actually going to increase or decrease. Okay, and another important factor of employment are the types of jobs being added. So that's something that we oftentimes don't talk about. I'm thinking about doing a non-farm payroll next week because we have non-farm payroll coming out next week, and I'll go over that and help you guys rationalize employment in that aspect of things. Okay, so very important indicator there. So after that, we have economic growth. Okay, just blatantly economic growth, and we have trade. So you have things like PPI, okay, purchasing price index. You have things like PMI, okay, producers managers index. You have imports, all right, and exports, okay. And if you have imports and exports, you also are going to have trade balance. All right, how much are we exporting versus importing, and what's the current standing of that? Okay, in an economic expansion, we want to be taking on a little bit more imports than exports. All right, because if we're just still producing a lot in the economy and pushing that out of the economy, then we're going to have an increase and we're going to have an increase again in inflation. Okay, if we're in a recession, well, we want a lot of exports. Okay, we want to be producing a lot within the economy, and so that way, well, again, we're increasing productivity within the economy. Okay, so again, it's varying degree. A lot of times people say, oh, the economy is functioning at a trade deficit. Well, if the economy is expanding extremely fast, you might want to be functioning at a trade deficit, all right? So that's something that's very important there. So a third one is geopolitical events. Okay, so things like, Marie Le Pen versus Macron back in April. All right. Again, if she won the election back then, it was a potential that you would have France leaving the European Union. That had heavy implications on the currency. That would have also had heavy implications on the productivity of the economy. Okay. You had situations like Brexit. All right. We saw investing go down after Brexit, okay, investing into the UK, okay, and so since investing went down, you had a decrease in productivity, all right, even though they did pretty well in their latest GDP figure. You saw how Brexit did have implications of on how productivity was functioning in the economy, and that again weighed down the currency. And a few things I didn't mention inside Geo were actually things like war, right? So North Korea, you guys have seen that that has had implications on our currency price. It's had implications on gold prices. Again, that affects the economy, the push and pull there. You also have natural disasters. Natural disasters have definitely massive implications short term, usually on economies. Recently we've seen that we had a lot of different weather patterns aligned to having all these hurricanes. Puerto Rico right now has zero electricity running within the economy at the moment. Again, those have heavy implications on economies there. So last but not least, we have commodity prices. As you guys know, again, definitely have heavy implications. When you're dealing with a commodity-based currency, a lot of times you'll hear that jargon there. People will relate the prices of gold, prices of oil. We do that inside of our community all the time and compare and contrast that and say, okay, guys, we're having a huge uptick in oil prices. Let's look to start buying the Canadian dollar, for example, right? So if I showed you guys a chart back when gas was fairly cheap, you would have seen that the Canadian dollar was actually doing fairly poorly, okay? But then once gas started coming back around and gas prices started to increase, you'll see the Canadian dollar again start to increase in terms of its economic divergence, US versus the Canadian dollar, all right? Why is that the case? Well, that's because literally 25%, okay, a quarter of all exports that are happening within Canada are in their natural resources, okay, in their mineral deposits, that being oil, okay? So guys, just when you look at the economic data coming out on Forex Factory, okay, on trading economics, look for it in terms of productivity. That is usually where most of the economic data is functioning, all right? Certain times you'll see things regarding interest rates. Usually, again, you might be able to peg interest rates to certain things involving CPI, but at the end of the day, CPI has a lot to do with economic growth. Okay, that's number 2 for us. All right, we have the PMI, we have you can have CPI here as well. How much are people actually spending on certain goods in the economy? That deals with productivity, all right? And that's what you can section off different economic releases to help you guys rationalize exactly what you're looking for, okay? So that is highly important. One more thing I want to talk about to you guys before we end this segment. Now, traders, this is the most important part of the entire spiel here, okay? Economic divergence. Remember everything that I just helped you guys rationalize, all right? Depending on the speed of the economy, you're going to get a certain interest rate, okay? But the thing about today's economy is it's a global economy, all right? We do exports into China. China has exports into the United States. Okay, we have lots of different, geo and national conglomerates, functioning in every single different country. Okay, certain companies have footprints in over hundreds, different countries. We're all interconnected. All right. Back in the day, you could have one economy fail, and I'm talking about potentially, maybe back into the, early 1900s. Maybe you could have an economy fail, and you as a functioning economy not do so bad. But after we started manufacturing cars, that's probably where everything started, and then manufacturing software and computers, and then clothes and everything else, and then food. After we became so interconnected, if one country sneezes, okay, they all sneeze. So I want to show you guys a picture here. These are different economies. You can rationalize this as the US. You can rationalize this as maybe the Euro, or maybe just the UK. You can rationalize this as the Australia and maybe the New Zealand dollar. They all are moving in the same direction. They're all wanting economic growth, okay? But if one country has a hiccup, imagine that they're all tethered together, okay? When the US failed in terms of its banking system in 2008, imagine these cars are moving along, all right? They're all pushing along, and then boom, you have this huge roadblock here in the US. Well, then what happens? You have all these countries start to smush together. So the divergence that originally existed kind of evaporates. They all start failing a bit, okay? But once the US started to pick up, this right here, guys, this is your edge. And I'm trying to help you guys rationalize that this is the money maker, this in between right here. Because if you have one economy going backwards and you have one economy going forwards, then the currency pair is going to be changing in value immensely. All right, you're going to have the euro going in this direction, okay, for example, and you will have the US dollar going in this direction, for example. Well, as the euro is appreciating and the US dollar is failing, in many occasions, what's going to happen, folks, you're going to have this parabolic move. That's what we've seen happen this year, okay? But the US can only fail so much until it affects the euro. You guys get what I'm saying? So maybe if you get a situation where, you know, the New Zealand can fail, Cyprus, for example, Spain, for example, those economies really haven't rebounded so well since 2008. Well, you have over here the euro, you have over here the US dollar. Again, those economies are pushing forward. So you see this tethering right here. Imagine this to be a rubber band. You see these getting pulled backwards as these economies are moving forward. And eventually you usually can see these economies start pushing forward because there's investment in these economies here, okay? There are companies from these entities here, from these countries here, that are inside of these economies there, right? So eventually you will have the laggards pull up, but it may take some time. And in that time, you can trade that economic divergence, okay? So there's just so many scenarios where, as the US, for example, look at the US CAD this year alone. We came from, I think, the $1.36s, and we went as low as the $1.22s. Okay, that is a prime example of the Canadian dollar, the #1 G7 currency in the entire world, okay, versus the US dollar. A very, very dismal situation. I can show you guys the DAX right here. The US dollar, comparably to all the other currency pairs, have been doing worse and worse and worse. If you guys can understand how these economies are standing here, okay, all these different vehicles that are driving, if you can understand they're standing relative to another economy, that is the edge. The economic divergence is how you're making your money. You're trading the split between this economy moving slowly and this economy doing well. You're putting your capital and betting that this economy is going to do well relative to this one. And as that comes to fruition, you're getting paid in between there. Okay, so economic divergence, folks, is how all the central bankers and how all the major market participants are actually trading. All right. They're not using technical analysis. Technical analysis, you know, only gives you so much of an edge. Technical analysis for myself is more or less precision. It is a necessity for sure. But understanding the economy as a whole and the split and the moving between those economies, expanding and contrasting against each other, is where you find the biggest edge. Okay? So if you can conceptualize this here in the long run and build a model around this, then you will be able to make money. Okay, it's just about getting in, you know, during those weekly scenarios. Okay, in those intraday scenarios where that divergence is happening very, very incrementally. There's a lot of noise, you know, in between that process. All right, there's a lot of noise on the intraday chart. There's even a lot of noise on the weekly chart sometimes. But in the long run, if you know an economy is performing and you know another economy is suffering, eventually you will get that split here, and then that is where you make your money, on the bet that that economy is going to fail, or on the bet that this economy is going to start picking up its pace. Okay, so guys, economic divergence is the way that the major institutions are making their money. And if you can rationalize economic divergence and understand all the different variables that allow economy to do well or allow an economy to do bad, then you can make money trading in that capacity too. Okay, so guys, if you need any more help with this, head over and get inside of the Top Trader community. It is our trading style. Other than that, folks, like and subscribe. Give me some more questions, okay? Give me some feedback if you guys need help conceptualizing, you know, this process right here. But that is the edge, okay? That is the edge, and that is where you're gonna make most of your money. All right, so guys, your profit, always my motive. Excited to keep cranking out on these high impact videos. All right, I'll see you guys next week. Peace.